crypto custody crisis explained, why you might not really own your Bitcoin or ETH. What if I told you that the Bitcoin or Ethereum you think you own might not actually be yours? You see, in the world of crypto, there's a hard truth that too many investors ignore: are not your keys, not your coins. It's more than just a catchy slogan, it's a warning. And right now, that warning is becoming more urgent than ever. Over the past year, we've watched billions in digital assets vanish overnight, locked, frozen, or lost forever. FTX, Celsius, BlockFi, one by one. Platforms that were once trusted by millions crumbled. And with them, so did the illusion of control. Most crypto holders don't realize that when they leave their coins on an exchange, or even with some custodial wallets, they're essentially handing over ownership. Legally, operationally, and in practice. If that third party goes down, gets hacked, or refuses withdrawals, you're left with nothing. This isn't just a security issue. It's a systemic risk, one that strikes at the very foundation of crypto's promise, sovereign ownership. But how did we get here? Why do so many people willingly give up control over the very assets designed to eliminate middlemen? And more importantly, what can you do to truly take back ownership? In this video, we're diving deep into the crypto custody crisis. We'll expose how custody actually works in the crypto world. Why even big institutions are getting it wrong. And how to protect yourself before it's too late. Because in the next chapter of crypto, ownership isn't optional, it's survival. Make sure to hit like, subscribe, and share this video with others who need to hear the truth, right here on Money Minded. Let's get started. Chapter 1. How crypto custody really works. When people think of owning cryptocurrency, they usually imagine something simple, like holding money in a digital wallet on their phone. But crypto custody isn't that simple. In fact, the way ownership works in the crypto world is very different from traditional finance, and if you don't understand it, you could be walking straight into a trap. Let's start with the basics. What is custody in crypto? Custody, in its simplest form, means who controls the private keys to your crypto assets. In crypto, your coins don't actually sit in a wallet the way cash sits in your physical wallet. Instead, ownership is defined by the blockchain. Whoever controls the private key, a long string of cryptographic data, controls the assets tied to that wallet address. If you lose the key, you lose access. If someone else holds the key, they own your coins, not you. This is where the custody problem begins. The illusion of ownership. Most new crypto users don't set up their own wallets. Instead, they sign up with centralized exchanges like Binance, Coinbase, or Kraken. These platforms offer user-friendly interfaces, easy trading, and account recovery, just like online banking. But there's a catch: they control the keys. When you deposit your Bitcoin or ETH into one of these platforms, you're not technically holding crypto anymore. You're holding an IOU, a promise that the platform will let you withdraw when you ask. But history has shown this isn't always the case. Just look at the collapse of FTX. When customers tried to withdraw, they discovered the exchange had been misusing their deposits. Billions vanished. Why? Because users didn't actually control their coins. And it doesn't stop with failed platforms. Even regulated custodians like banks or large institutions are often legally listed as the owners of the assets they hold on your behalf. In a bankruptcy scenario, you could be considered just another creditor. Types of crypto custody. To understand this better, let's break custody into three main types. 1. Centralized custody of exchanges and platforms. The most common method. Platforms like Coinbase hold your keys. You get convenience, but zero control. If they freeze your account, get hacked, or go bankrupt, you're out of luck. 2. Third-party custodians, institutional custody. Used by investment funds, large holders, and sometimes even governments. Firms like BitGo or Anchorage offer regulated custody. Still, the custodian holds the keys. You're depending on their risk management and legal structure. 3. Self-custody, you hold the keys. Using hardware wallets like Ledger or Trezor, or software wallets like MetaMask. You generate and store your own private keys. Higher security and ownership, but only if you manage it responsibly. Why most people still choose centralized custody? So if self-custody is the only way to truly own your crypto, why don't more people use it? Simple, it's scary. Managing private keys requires a level of discipline and technical understanding. If you lose your recovery phrase, there's no one to call. No forgot password button. That fear drives people back to centralized platforms, even though they know it's risky. There's also the false sense of security that comes with brand names. People trusted Celsius, Voyager, and BlockFi until they collapsed. The irony? Crypto was invented to eliminate the need for trusted intermediaries. Yet here we are, recreating the same risks of traditional finance in a decentralized system. The core truth: custody is the real decentralization test. At the heart of it all lies a critical truth. Crypto custody determines who actually benefits from decentralization. If you hold your own keys, you own your financial freedom. If someone else holds them, you're no different than a bank customer, except without FTIC insurance. In fact, recent regulatory proposals in both the US and Europe are starting to blur the lines even more. Some are pushing for mandatory third-party custody for crypto assets, claiming it's safer. But safer for who? That's the real question. Ownership without control is an illusion. And in the next chapter of this story, we'll see why even major institutions are struggling with custody, and what happens when the lines between legal ownership and technical control collide. Your financial freedom depends on it. Chapter 2. Why even big institutions are getting crypto custody wrong. If you think crypto custody is only a retail investor problem, think again. Some of the world's largest financial institutions, including hedge funds, asset managers, and even government-backed entities, are struggling to figure it out. And in many cases, they're getting it dangerously wrong. This isn't just a technical issue. It's legal, operational, and philosophical. Because while crypto was built to give individuals full control over their assets, most institutions are built on the exact opposite principle: centralization, delegation, and trust in third parties. So what happens when these two worlds collide? Let's break it down. The institutional dilemma. Institutions, by law or by internal policy, often cannot hold their own private keys. Whether it's a pension fund managing billions in assets or a publicly traded company buying Bitcoin for its balance sheet, they need someone else, a regulated custodian, to safeguard those assets. This seems logical. After all, these firms are accountable to shareholders, regulators, and boards of directors. They need clear audit trails, insurance policies, and legal frameworks. But here's the problem: when you introduce a custodian into the mix, you fracture the core value proposition of crypto: direct ownership and trustless control. And when something goes wrong, the consequences are severe. Just ask any institutional investor who had funds tied up in FTX or Celsius. Many of them were using approved custodians or relying on terms of service that seemed ironclad. But when the collapse happened, they discovered the truth. Having a legal contract doesn't mean you have actual control. The legal gray zone. One of the biggest issues in institutional custody is the lack of legal clarity around asset ownership. In traditional finance, assets held with a custodian are clearly defined. Securities are registered in your name or in the name of a nominee, with legal protections in place. But in crypto, things aren't so clear. Who owns the coins, the custodian, the client, or a trust account? If a custodian goes bankrupt, will your crypto be returned to you or liquidated to pay off creditors? This ambiguity has already led to legal battles. In the case of Celsius, courts ruled that users who deposited funds had essentially given ownership to the platform. That meant depositors were considered unsecured creditors, standing in line behind lawyers, executives, and other stakeholders. And this is where even large firms are vulnerable. If they don't understand how custody agreements are structured, technically and legally, they could be exposing themselves to massive hidden risks. The technology gap. There's also a fundamental knowledge gap. Many institutional investors rely on traditional custody models, which are often paper-heavy, slow, and manual. But crypto operates 24/7, with no off switch and no margin for delay. The private key must be stored, accessed, and signed securely. Even the smallest mistake, like failing to properly air-gap a signing device, could lead to catastrophic loss. Some institutions try to solve this with multi-party computation, MPC, cold storage solutions, or geographically distributed key shards. These can be effective, but only if the organization fully understands what it's doing. And most don't. In fact, several firms that marketed themselves as crypto custodians in recent years turned out to be little more than centralized wallets with weak internal controls. When things go wrong, it's not just a headline. It's a lesson in how fragile the system still is. The centralization trap. There's a deeper issue at play here, one that goes beyond legal frameworks or technological solutions. And that's the slow but steady re-centralization of crypto infrastructure. As institutions enter the space, they bring their habits with them. They rely on intermediaries. They demand custodians. They trust third-party risk officers and compliance departments. But in doing so, they recreate the very structures crypto was designed to disrupt. That's not just ironic, it's dangerous. Because if we rebuild the financial system on the blockchain, but fill it with the same old dependencies, have we really changed anything? Or have we just digitized the same problems? A crisis of principles. At its core, the crypto custody crisis isn't just a matter of control. It's a matter of values. Institutions are increasingly pouring money into crypto assets, not because they believe in decentralization, but because they see upside. And to manage that exposure, they are building systems that are safe for them, but potentially dangerous for the rest of us. They're lobbying for regulations that favor custodial models. They're standardizing infrastructure that limits self-custody. And in some cases, they're even pushing for outright bans on individual wallet control, all under the name of consumer protection. If we're not careful, the future of crypto could look very much like the past, a world where access is restricted, intermediaries dominate, and real ownership is a privilege, not a right. Coming up next, in Chapter 3, how you, as an individual, can take back control. Because this isn't just a crisis. It's a choice. Chapter 3, how to truly own your crypto before it's too late. By now, the message should be clear: if you don't control your private keys, you don't truly own your crypto. But here's the good news: this isn't some theoretical problem you're powerless to fix. You can take back control. Self-custody is the most powerful, and most underused, feature of cryptocurrency. It allows you to bypass banks, brokers, and exchanges. It gives you direct access to your money, anytime, anywhere, without permission. And in a world where platforms collapse overnight, that kind of independence is priceless. But self-custody is not just about buying a hardware wallet and calling it a day. It's about understanding the risks, the responsibilities, and the right way to protect yourself before it's too late. Let's walk through what you need to know. Understanding self-custody. At its core, self-custody means generating and storing your own private keys. That key is what proves ownership of your coins. Lose it, and the coins are gone forever. Expose it, and someone else can steal everything instantly. So before you make the leap, you need to understand two things. You are becoming your own bank. That means you are also your own security team. This isn't something to take lightly. But with the right tools and habits, it's not as intimidating as it sounds. Step 1. Choose the right wallet. There are several types of wallets, but not all are equally secure for long-term self-custody. Here's what you need to consider. Hardware wallets. These are physical devices, like Ledger, Trezor, or Coldcard, that store your private keys offline. They're ideal for long-term holders who want maximum protection. Your keys never touch the internet, making them highly resistant to hacks. Software wallets. Apps like MetaMask, Exodus, or Trust Wallet are more convenient, but they're connected to the internet, which makes them vulnerable to malware, phishing, and user error. Best for small amounts or frequent transactions. Paper wallets. Literally printing your key or seed phrase on paper and storing it somewhere safe. While extremely low-tech, they can be secure if generated offline and stored properly. But they're fragile, easy to lose, and hard to use. For most people, a hardware wallet is the best balance between security and usability. Step 2. Secure your recovery phrase. When you set up a wallet, you'll be given a seed phrase, usually 12 or 24 random words. This is the backup to your private key. If your wallet is lost or destroyed, the seed phrase lets you recover your funds. But here's the thing: anyone with that phrase can access your crypto. That's why securing it is critical. Never store it digitally, not on your phone, not in your email, not in cloud storage. Write it down on paper or engrave it on metal. Store it somewhere only you, or someone you trust deeply, can access. Some people go even further, splitting their seed phrase into parts and storing them in separate physical locations. Others use password-encrypted backups or multi-signature wallets to reduce single points of failure. The key idea: treat your recovery phrase like gold, because that's what it is. Step 3. Practice safe habits. Even the best wallet won't protect you if you click on a fake link or fall for a phishing scam. That's why custody also means vigilance. Always verify websites and URLs. Never share screenshots or login prompts on social media. Be skeptical of unsolicited DMs and support requests, even from official accounts. Update your devices regularly and use strong, unique passwords. You don't have to become a cybersecurity expert. But you do need to adopt a security-first mindset, because once crypto is gone, there are no chargebacks or customer service calls. Step 4. Know when not to self-custody. Here's something you won't hear often: self-custody isn't for everyone, all the time. If you're trading frequently, managing assets for others, or holding large institutional sums, a hybrid approach may be better, using regulated custodians for one part of your portfolio, and self-custody for another. And if you're not ready to take on full responsibility, it's okay to wait and learn first. Custody is not just a technical decision. It's a personal one, based on your risk tolerance, your goals, and your level of confidence. But if your goal is financial sovereignty, true crypto ownership is not optional. The takeaway: self-custody is not a magic shield. It comes with real responsibility. But it's also the purest expression of what crypto was designed to be: the decentralized, borderless, and permissionless. When you hold your own keys, you hold your freedom. No one can freeze your funds. No one can dictate your access. No one can rug pull your future. And in a financial world that's increasingly unstable, that might be the most valuable asset you own. Coming up next, the final chapter, where we'll tie everything together and look at where this custody crisis is headed, and what it means for the future of crypto. Don't forget to subscribe to Money Minded, and share this video with anyone who still thinks their coins are safe just because they see a balance on a screen. Conclusion: ownership or illusion, the choice is yours. We started this journey with a simple but alarming truth: you might not really own the crypto you think you do. We've seen how centralized exchanges and custodians offer convenience, but at the cost of control. We've uncovered how even major institutions, with teams of lawyers and billions under management, are vulnerable to the same custody traps that retail investors fall into. And we've explored what it actually takes to reclaim true ownership in the world of crypto. But now, as we close, the question becomes personal: what will you do with this knowledge? Because the custody crisis isn't just a technical failure. It's a philosophical one. It's the result of forgetting what crypto was built for in the first place: to give people freedom over their money, to remove the need for permission, to escape the grip of systems that can fail, freeze, or seize your wealth. Right now, millions of people still leave their coins in centralized wallets, trusting that nothing will go wrong. But history tells a different story. Platforms collapse. Laws change. Keys are lost. And when that happens, it's always the same excuse: I didn't think it would happen to me. But here's the truth: it doesn't have to be this way. You have the tools. You have the opportunity. And now, you have the awareness. If you believe in the future of crypto, not just the price charts, but the principles, then self-custody isn't optional. It's essential. And you don't have to go all in overnight. Start with education. Set up a hardware wallet. Practice with small amounts. Learn how seed phrases work. Understand what it feels like to own and control your digital assets without relying on a third party. Because in a world of increasing surveillance, tightening regulations, and financial instability, your keys are your passport to sovereignty. At Money Minded, we believe financial freedom starts with awareness and leads to action. That's why we break down complex truths like this, so you can make smarter, safer, and more independent decisions about your money. So if this video helped you see the crypto custody crisis in a new light, do us, and yourself, a favor. Like this video. Share it with someone who needs to hear this message. And subscribe to Money Minded for more deep dives into the truth behind global finance and digital assets. Because in this space, knowledge isn't just power, it's protection. Thanks for watching. Stay safe, stay sovereign, and we'll see you in the next one.